Module 6, Inventory. Inventory turnover ratio. The inventory turnover ratio is a financial metric that measures the efficiency of a company's inventory management. It indicates how often a company's inventory has been sold and replaced during a specific period. A high inventory turnover ratio suggests that a company sells its products quickly and efficiently. In contrast, a low ratio may indicate that a company experiencing slow sales or inefficient inventory management. The formula for calculating the inventory turnover ratio is as follows. Inventory turnover ratio equals cost of goods sold divided by average inventory. The cost of goods sold is the cost of the inventory sold during the period, while the average inventory is the average value held during the period. For example, if a company had cost of goods sold of $500,000 and an average inventory value of $100,000, the inventory turnover ratio would be calculated as follows. Inventory turnover ratio equals $500,000 divided by $100,000 equals 5. This means the company sold and replaced its entire inventory 5 times. A high inventory turnover ratio is generally considered favorable, indicating that a company effectively manages its inventory and generates revenue from its products. However, a very high inventory turnover ratio may suggest that a company needs more inventory to meet demand, which could result in lost sales. On the other hand, a low inventory turnover ratio may indicate that a company is holding too much inventory, which can tie up capital and lead to higher storage and handling costs. Days sales in inventory. Days sales in inventory, or DSI, is a financial ratio that measures the average number of days it takes for a company to sell its inventory. It is also known as inventory days or days inventory outstanding. This metric provides insight into how effectively a company is managing its inventory and can be used to identify potential inventory management issues. The formula for calculating DSI is DSI equals average inventory divided by cost of goods sold times number of days in the period. The average inventory is calculated by adding the beginning and ending inventory for a period and dividing by 2. For example, if a company had a beginning inventory of $100,000, an ending inventory of $75,000, and cost of goods sold of $500,000 during 365 days, the DSI would be calculated as average inventory equals $100,000 plus $75,000 divided by 2 equals $87,500. DSI equals $87,500 divided by $500,000 times 365 is equal to 63.88 days. This means that, on average, the company takes about 64 days to sell its inventory. A low DSI is generally considered favorable, suggesting that a company sells its inventory quickly and efficiently. However, a very low DSI may indicate that a company needs more inventory to meet demand, which could result in lost sales. On the other hand, a high DSI may suggest that a company is holding too much inventory, which can tie up capital and lead to higher storage and handling costs. First in, first out. FIFO stands for first in, first out, and is an inventory valuation method. It is based on the assumption that the first goods purchased or produced are the first to be sold or used, and the most recent goods are kept in inventory until the earlier ones have been sold or used. Under the FIFO method, the cost of the oldest inventory items in stock is assumed to be the cost of the goods sold or used first, while the cost of the newest inventory items is assumed to be the cost of the goods still in inventory. This means that the cost of goods sold is based on the cost of the oldest inventory items, and the ending inventory is valued at the cost of the newest items. FIFO is often used by companies that sell products with a short shelf life, such as food or clothing, where the oldest items must be sold first to avoid spoilage or obsolescence. It is also preferred by companies that want to minimize their tax liability, as it can result in lower cost of goods sold and higher profits, reducing the amount of tax owed. One of the drawbacks of FIFO is that it can lead to distorted inventory valuation during times of inflation or rising costs, as the cost of the newest inventory items may be higher than the cost of the oldest items. This can result in a higher valuation of inventory and higher profits, which may not reflect the actual value of the inventory. Perpetual Inventory. Perpetual inventory is a system of inventory management that continuously tracks inventory levels in real time. It provides a highly accurate and up-to-date record of inventory levels, allowing businesses to manage their inventory better and make informed decisions about purchasing, stocking, and selling products. A perpetual inventory system updates inventory levels automatically as goods are received or sold. Each time a product is sold, the system reduces the inventory level. Each time a new product is received, the system increases the inventory level. This means that the inventory level is always accurate and up-to-date. Perpetual inventory systems often use barcoding, radio frequency identification, or other automated tracking technologies to monitor inventory levels in real time. This enables businesses to easily track inventory movements, identify shortages or surpluses, and optimize inventory levels to reduce waste and improve efficiency. Perpetual inventory systems also enable businesses to generate reports and analyses of inventory data, such as stock levels, turnover rates, and reorder points. This information can forecast demand, identify trends, and make data-driven decisions about inventory management. One of the key advantages of a perpetual inventory system is that it can reduce the risk of inventory stockouts or overstocks, which can result in lost sales or increased storage costs. It also provides better visibility into inventory levels, making it easier to identify and address inventory issues before they become a problem. Under the FIFO perpetual inventory method, the cost of goods sold is based on the assumption that the oldest goods purchased are the first ones sold. For example, assume 10 units of inventory are purchased on August 1st for $10 each, and 20 are bought on August 3rd for $12 each. Then, 12 units are sold to a customer on August 6th. What is the COSG of these 12 units? So, first, we observe that the 10 units purchased on August 1st are the oldest, followed by the 20 units purchased on August 3rd. To calculate the cost of goods sold for the 12 units sold on August 6th, we need to determine the cost of the oldest 12 units in inventory. On August 6th, we sold the 10 units purchased on August 1st and 2nd of the 20 units purchased on August 3rd. This gives us a total of 12 units sold. The 10 units purchased on August 1st cost $10 each, for 10 times $10 equals $100. The cost of the 2 units from the August 3rd purchase is $12 each, for a total of 2 times $12 equals $24. Therefore, the cost of goods sold for the 12 units sold on August 6th is $100 plus $24 equals $124. The Materiality Constraint. The materiality constraint is an accounting principle that requires financial information to be reported only if it is significant enough to affect the decision-making of a reasonable person. This means that accounting standards do not require a company to report every single transaction or detail, but only those considered material or significant. In other words, the materiality constraint recognizes that not all financial information is equally important or relevant to users of financial statements. Instead, it allows companies to use their judgment to determine whether a particular item is significant enough to be reported. Determining whether a particular item is a material depends on various factors, including the item size relative to the company's overall financial position, the nature of the item, and the impact it may have on financial statements. For example, a small error in an expense account may not be material if it has no significant impact on the financial statements. On the other hand, a significant loss or gain in a single transaction may be material and require disclosure in the financial statements, even if it is not typical for the company. The materiality constraint is essential because it helps ensure that financial statements are relevant, reliable, and useful for decision-making. It also helps prevent companies from burdening users of financial statements with unnecessary or irrelevant information, making it more challenging to understand and interpret financial results. Year-end inventory. A company should include only the units it owns and controls in its year-end inventory. Assume a warehouse contains 10,000 units, of which 1,000 were damaged by flood and are not sellable. Another 4,000 units are purchased from a second company, but are still in transit at the end of the year. The 1,000 damaged units are not sellable and should not be included in the year-end inventory. The 4,000 units purchased from the other company are still in transit and have yet to be received. Therefore, they should be excluded from the year-end inventory. Although the company owns these 4,000 units, it should not count them as inventory. We can thus calculate the number of units that Sandoval should include in its year-end inventory as follows. Total units owned minus units in transit minus damages units equals 14,000 minus 4,000 minus 1,000 equals 9,000. Therefore, it should include 9,000 units in its year-end inventory.